Hello, and welcome to the RTO Show. I'm your host, Pete Shau, and today we're out here in this big building all the way downtown to meet with the guys of RGCO. Look at those faces. I love you guys. You guys are amazing. So Mike Helton and Alicia, is it Holloway?
Yeah.
All right. So Mike was like, I don't want to do this alone. I need to bring some help. So he brought the big guns out. She's over here making sure it's going to happen, right? Mike, how you doing today? How's everything going? Dude, I swear to you, as I came in here, this place is amazing. Like, this place is seriously amazing. So I figured maybe 3-4 offices, there's like 3-4 offices on this corner of the building. So we are literally an entire floor downtown on 201 North Franklin Street. And I'm not going to tell you what floor because you're going to have to figure that out on your own. But I come down here and I'm just telling you guys, I was amazed as I walked through the door. It's absolutely beautiful. If you guys can't tell, the skyline is absolutely amazing. We're going to do a talk here and kind of pick their brains. Mike made me swear that I was going to talk about this big, beautiful bill and how it affects you. So we're going to go over that. First off, how you doing, Mike? How's everything going?
Good, Pete. Thanks for having us.
Yeah, I'll tell you right now.
I really appreciate it. I'm honored, really, to be here.
Well, I'm glad you're here. I'm glad that you're here. You guys don't know. We had to twist some arms to get her over here, but she made it.
Just
She's
a little
good.
bit.
So tell me a little bit, Mike, there's so much about you I didn't know.
Yeah.
There's a lot about you I didn't know.
There's probably more. I haven't told you, but that's okay.
There's so much about Mike Helton that you just don't know, but we're going to figure it out today. First off, tell me a little bit about your background. Like, where do we start? And, I mean, we're going to have to figure out how we got here, but where do we start? Where does your prowess and professionalism come from? Where do you start at?
I grew up in Ashland, Kentucky, so my start got there. Well, it started there, and then went to school in Southern Ohio, Shawnee State University, and got into the accounting program at that point in time. Did my first internship for a CPA firm up there locally. Did that for a few summers, and then they hired me full-time after I graduated. So that's how I got involved in this public accounting business. Not long after that, I migrated to Florida. I was about 26 years old, a long time ago now. But came to Florida, and the rest is history as far as that goes. I never really wanted to go back. I love it here, here in Tampa. Beautiful. And so thrilled to be here.
Well, rent to own is a crazy world, because a lot of the people that I know in rent to own never started in rent to own. They were doing something else, and somehow they migrated to the rent to own industry from one reason or another, whether they had parents that were starting in the business of something else, retail, sales, where Slats, he decided to kind of stretch out what he was doing and apply it to something else. And then here comes the rent to own industry to follow. We always kind of start somewhere else, but I've always seen accountants usually know what they want from the beginning. You usually know, like, whatever it is, this is what I'm going to do. And most of the time, accounting is not rent-to-own's favorite thing to do, but it is so important because absolutely it's different from a lot of the other businesses that we go through. I know that
Did you know what you wanted to do when you went to college?
I'm looking at her face. She knew it.
I actually did.
See what I tell you? I knew it.
I took an accounting class in high school, so.
Now you're a native to Tampa, right, or the area?
Cape Coral, so 2 hours south.
You're not that
basically.
far away.
Came here for college and never left.
Where did you go to college?
University of Tampa, right there.
Right. I can't show it to you guys, but it's right out there. It's actually one of the most beautiful schools in the Florida area, in the Tampa Bay area, but in Florida, it's like absolutely gorgeous. So you played a little basketball?
I did.
I would have never got that. If you guys haven't met Mike, I'm going to tell you right now, he is not the normal accountant type of guy. Like, you are completely, you're the one that will stand out in the group, for sure.
I've been told that before. No, my background, Dad was a steel worker. My mom worked in the lunchroom at the high school, blue-collar neighborhood. Sort of remember around 8th grade, probably, shooting basketball in the backyard. We had a goal, as everybody does in Kentucky.
Right.
It's pretty common.
Yeah.
Shooting basketball in the backyard. And the kids that day at school were sort of talking about what their parents were doing for college fund. I'd never really heard or talked about a college fund before. So I go home and I ask Dad, he's grilling some burgers on the grill, while I'm shooting, and ask him, I say, hey, Dad, by the way, what kind of college fund y'all put away for me and my brothers? I've got 2 brothers.
You put them on the spot.
One older, one younger. I said, yeah, just tell me what kind of college fund y'all have for me. He looked at me, he said, see that basketball in your hand? He said, keep shooting. That's your college fund. So right then and there, I sort of knew that was going to be my path. I was not a straight A student. Athletics was going to take me to college, and it did. And luckily, I had all years of school paid for, so on scholarship.
Beautiful. So in the world of accounting, how in God's name did you find rent to own back then? I mean, you look at it today, and the progression that we were talking about, I was talking about before, is, there was a lot of independents, and there was only like 2 or 3 big guys. There was Rack, there was Aaron's. I don't even, Buddy's really wasn't as big then as it is now, or at least a name brand and, where it came from. Now you've got larger names like the Rent and Roll and Rent a Wheel are also getting big. But how do you guys get into the world of rent to own? Because now I would say that you're like one of the experts as far as accounting in rent to own. I mean, you guys know this industry in and out, which is something a little bit different than, normal retail or normal accounting, period. I mean, there's a lot of factors that go into everything that we do that a lot more of now than almost anybody I know. There's very few that handle the business. How did you get into rent to own? Where did that start from, playing basketball, talking to dad, and then all of a sudden here you are?
So I migrated to Florida, had a short stint at a firm in Clearwater, then found this place. So just had my 26th anniversary of employment here at this firm.
Wow.
26 years. That makes me one of the old guys. But when I first started here, it wasn't long after starting, Slats had just passed away. And this is Norman Slatton, and the founder of Buddy's. And our firm represented and worked with the attorney and was working on his estate. So Slats' estate was one of the first things I did when I started working here. And that's how I was introduced to the Slatton family. And so from there, we did a lot of estate planning work for Miss Slatton and the family, and did, it started from there. And that's how I met Joe Gazzo and Jamie and some of those guys. And it wasn't long before they started asking me questions about the company. We did not represent the company. We were only representing the family. And at some point in time, they transitioned the company work to our firm, wanted us to take over that. And that's how I got really introduced to rent to own. Shortly after that, they told me for like 2 years, you really need to start coming to some of these shows. You need to start coming to some of these shows. I'm like, I didn't even know what they were talking about. Right. Eventually, I made it to my first meeting of the minds out in Vegas. And
what year was this?
Great one to go to.
Yeah.
It was pre-2010. I was trying to think like how long ago it's been since my first show. It's been easily over 15 years, but not quite 20. So it was somewhere in the late, probably 2008, 2009, maybe 2007 period. I don't know, somewhere around there.
That was a hard time for rent to own back then.
Yeah, well, it was, back then I was still trying to grow a client base, still am, but, I was really trying to grow a client base at that point in time. Didn't know a soul, and, spent a lot of time with Terry Bevel back then, who taught me a lot of the rent-to-own accounting. There was nobody better to learn it from, quite frankly. So I spent a lot of time with him and Joe, and Jamie literally dragged me by my arm and introduced me to everybody at these shows.
Because that's Jamie.
That's Jamie.
That's Jamie.
And everybody knew Jamie. So that's how I got sort of baptized into rent to own. And ever since my first show, credit to this firm, I came back and said, hey, we really need to get more involved in this industry. I think there's a lot of work out there that we could get, and that they seem to need a lot of help. And came back and talked to the partners. I wasn't a partner at the time, came back, talked to the partners and see if they would support it. And they did, and continued to send me to shows where I actually had a booth and everything at that point in time. And we've grown it ever since.
Let me ask you something. Are you getting everything out of your rent-to-own business? If you're not an A-Pro member, then the answer is probably no. Look, advocacy is A-Pro's bread and butter. This is why they were created and what they do best. But here's the thing. APRO membership is about way more than advocacy. APRO connects you to the movers and the shakers of the industry. People who've been there, done that, and they can help you do it even better. APRO's monthly webinars give you expert insights and actionable takeaways. It's like having a masterclass for your business every single month. Got questions about complex regulations or sticky situations? No problem. APRO's legal hotline gives you direct access to experts who have got the answers. That's a peace of mind that you can't put a price on. And let's not forget the resources, news, updates, and tools that keep you ahead of the curve. Scholarships for your team? Check. Disaster relief when you need it most? Double check. APRO is your ultimate support system in the rent-to-own world. So stop settling for less. With APRO, members get more. More support, more connections, more success. Head over to rtohq.org and join the APRO family today. Because in this business, more isn't just better. It's essential. See you at the top with APRO. Talking about going to shows, Alicia's now at the shows. I see her at all the shows now. I even see this, I don't want to say plaque, but this thing in your office where FRDA recognized RGCO as being one of the just one of the big names in the industry, and they appreciate you guys doing that. How did you find the industry? Or was it like, I'm going to RGCO and you know what? I'm part of the RTO division.
So, I mean, Janelle and I kind of got baptized because Kim left our firm, so we had a need to pull more people in. But it's an industry that I like being in. I feel like the people are all very genuine and they care about, like you hear at the shows, the owners, the managers, they're all saying that they know all the names of all their customers. Like, you don't hear that in other industries that we're in. So it's been really good to go.
It's eerie. The other day, I was in one of the stores. I hadn't been there in years. And I forgot what we were doing. We were talking about something, selling something at the front counter or something. And this other customer walks in. And he's like, "Hey, B, where you been?" I'm like, "Bro, what's going?" Like, it's crazy. Years later, I mean, they'll call you out, And I hadn't seen this guy in years. And then it was another customer. It was like 2 customers that came in after that I think there was, this, "Hey, how are you doing?" Because I used to run the store. It was actually the store in Armenian. It was nice to see those customers for whatever time frame that it was. It was just like catching up. It was like just how are the kids? How's your wife? How's this? How's that? But it's a relationship business.
And that's why I don't think you call them customers. I think they're clients of yours.
Absolutely.
In our business, we call them clients because of that personal relationship we have, deep knowledge of what they've got going on, both in their business and personally. Yeah. There's no different with your relationship with your rent-to-own folks. No. And to me, they're your clients because you know them inside and out, and they know you. You know their family. It's a much driven customer relationship business, as you know. I mean, we may sell different products or services, but it's built on relationships.
All of it's built on relationships, and you guys know that more than I mean, being here 26 years, you've had some long-term relationships, which kind of leads me into you start working for one of the pioneers of the RTO business. His son then follows in his footsteps of pioneering in the RTO business. So we're talking about Norm Slats, and then we're talking about Jamie Slat, and then you're talking about some of the other names. Like, I don't know if there was a person who started working in 2015 and before who didn't know Terry Bevel was. I mean, just the names alone carry a whole lot of weight. What did they teach you about rent to own, or what did they help you learn as far as what's the difference, just a blaring difference between the normal rent-to-own dealer industry, the way it works, and how it's run as far as financials versus a lot of the other clients that you have?
Well, the good thing is back then I was probably too stupid to know it was much different because I was pretty inexperienced. I've learned through the years of seeing other types of businesses how different it is. But I probably didn't appreciate it when I first learned it. So I was just sort of naked to everything. I was a sponge. And Terry would sit me in my office, in his office, and with all his Florida State stuff and everything around. And, we would go through general ledgers and trial balances and journal entries, and he would walk me through. I mean, he loved it. He loved it, and did not mind spending time showing me how that worked. Years later, I got the same sort of tutelage from Chris Cale Sr., who sat me down in his office and went through how he keeps track of things. and just had, that's what's always blown me away about this industry from my first meeting of the minds on, how much you all share information and collaborate for the greater good of the industry and protecting that business and transaction. The level and amount of information you all share on how you do things and what works, what doesn't work, has just blown me away, because you don't see that with other businesses
At all.
And I've
No.
received the same attention from people that have helped me through my career in this. I mean, it takes a village, as you know, and I've had a ton of help of people trying to help us gain traction in this business, and teach us that. And,
Yeah.
Bill French told me as a vendor.
Bill French.
Bill French.
Bill, we love you. I just tell you that we love you.
We always talk about it, still do to this day. After my first show, I was sort of depressed, and he saw me. I was sitting over there. Nobody lined up at my booth. Nobody talked to me. I was like this black cloud in the room that no one wanted to speak to. And Bill walked over. He put his arm around me literally and said, "Buddy," he said, "just keep showing up and it'll happen."
Yep.
And I remembered that. I was like, okay, I just got to keep showing up. And it was year 2, nobody came. By year 3, we started talking to people. And by the end of year 3, we started picking up some new business. And so it's very fraternal industry,
It is. It is.
Once I sort of became accepted,
Yeah,
then
once you're in.
I felt like, okay, I'm in now. And no, I haven't stopped showing up since.
Well, so talking about going, because you did say it's the right place to start. Are you going to Meeting of the Minds in Vegas this year?
I don't know, am I?
Oh, no.
She will not be there.
No.
Unfortunately.
Next one.
Those are generally the only ones we miss because they are smack dab in the middle of tax season.
Yeah.
It's usually like mid-March, and that's like our busiest time of year.
This one's in, I think February, the end of February. Either way, it's a hard time for you guys that time of year.
It's anything between what I say, Gasparilla. No one outside of Tampa knows. But from end of January through mid-April, we're pretty busy.
They're booked to pirate season, just so you guys know. So talking about taxes, talk to me, because one of the things that I really wanted to get into was everything else, and you brought my attention to the big, beautiful bill, which I appreciate because I'm not a tax guy. I really don't know this stuff. But I would imagine that this plays a big part in our rent-to-own lives today, for a lot of people listening and for in general knowledge. What happened when this bill passed? What is the differences and what are the changes that came along with it that might stand out in RTO?
Well, we were watching for a while, so this didn't just happen overnight. There were mumblings and grumblings for a while of what may happen. And then it finally became a big push. It was supposed to happen by the end of 2024. It didn't happen, sort of right after, then inauguration, all that stuff happened, and, got all that out of the way. And there were some other things that had to be dealt with Congress. So you got all that stuff out of the way, then they could finally focus on taxes again. So it happened probably a year after when we thought it might. But eventually, it was going to happen during Memorial Day, and then, July 4th became the day that they wanted to get it all done. So it was signed on July 4th of 2025. And the big thing for rent-to-own is it basically put back in 100% depreciation for bonus depreciation. That's the biggest thing that it did. Bonus depreciation is and has been the last few years ratcheting down. So it went from 100% down to 80, down to 60. This year it was going to be 40% bonus depreciation. And where that makes a big impact is on the turn. So you've got, not the turn in your world that you're thinking, turn in our world, meaning that, you expense something when you buy it, and then when you dispose of it on that flip, you've got to recapture that cost. So your book cost and your tax cost are very different at that point once you get involved with bonus depreciation. So, but to be able to buy an expense as you're paying for it instead of having to get the expense over time was a big swing. And that's helpful for small businesses, especially those that are funding their inventory purchases with operating cash.
Which is usually the case.
It is. Some people use it out of a line of credit. And so I do throw caution out there to the folks that are buying inventory with debt dollars. It's different than when you're buying inventory with your operating cash. Because you still have to pay back the debt, and then
eventually go away.
Then eventually you've got that flip on the tax bill. You get the expense going in, but then you got the recapture coming out. So it does cause some planning inconsistencies between your books and your tax numbers.
If anybody's using Versa right now, that is that little tax number up there above the book value line. I don't want to get into that because Lord knows I don't know much about it. But what immediate actions should these businesses take before year end to take advantage of this big, beautiful bill? Because it was signed on July 4th of 2025, which means that it wasn't in effect before that. It's going to affect this tax year, or is it coming to the 2026 tax? I don't know how that works.
Some of both.
Some of both. Okay. So what is it? Is it it's like, and for lack of a better term, I don't want to take this technical, but it's like a 50-50 thing. Some of it happens now, some of it happens later, based on because it was signed in the middle of the year, like literally in the middle of the year.
The bonus depreciation piece, oddly enough, what's the date? January 19th? Yeah. So because the bill was announced on January 19th, they made bonus depreciation effective on that day. So imagine that all your purchases between January 1st and January 18th don't qualify for bonus depreciation, but everything after January 19th does.
It would have been really nice if they put it back to January 1st.
Yeah.
I don't know why that 19 days had to be included in there, but they did. So
could it be because the president is sworn in on what, the 17th, 16th?
No,
17th?
It's the day that the bill was introduced.
Is it?
So,
Okay.
so the I can't imagine I've got one rent-to-own client that purchased anything this year between January 1st and January 19th.
That's usually a dead zone. January is a no-fly zone. I mean, that's one of the, don't do it.
Everybody's still on vacation. Christmas hangover.
Yeah.
They don't buy it until later in the year.
Yeah, the thing is, I think that usually the first purchases end up being around meeting of the minds because of that. Like, don't touch January. Let it sit. We've got to deal with everything that came out of the Christmas time. And
Right. Well, you do have a lot of holiday purchases, and so to mention, how we're planning for it. Right now, we're sort of still in the middle of fall busy season. September 15th and October 15th are big tax deadlines for us. That being said, right after the October 15th deadline, we start doing year-end tax projections for our business clients. And so that's when we'll start talking about the impacts of this bill and what that means, and running tax projections for them. Already had calls from people wanting to adjust their quarterly estimated payments and things like that as a result of it. So it will be impactful depending on whether you decide to take bonus depreciation, or you can actually elect out of it and not participate in bonus depreciation. It does cause some planning discussion.
Do both.
Yeah.
Go either way.
So let me ask you a question, because this is outside of my realm of doing. But you get a bill like this. It's a huge bill, right? Something comes down the pipe. You guys see it coming. You learn a little bit about it. But when these bills are passed and they're a law, what does it take to learn about this bill and then implement it afterwards?
A lot of reading. How many pages was it?
Yeah, it was about 1,000 pages. But we subscribe to plenty of sources. We spent a lot of money on research platforms.
Yep.
That every day there's something in our inbox from each of them about updates. And as the IRS comes up with new notices and new regulations and new just here's how we're going to address these new laws, we stay on top of that. And we share that information with our team here. So every day there's something coming up about reading. Yeah.
Is that the biggest? So this bonus depreciation, is that the biggest advantage that somebody in rent-own can take as far as this big beautiful bill is concerned, or is there other things that are involved in this that is really going to affect us directly? And not just, there's the broad stroke, right? It's going to affect everybody the same. If your tax percentage goes up, it goes up. It goes down, it goes down. Everybody's dealing with that. But is there anything else besides that really affects the rent-to-own community where they can say, well, this was an advantage or a disadvantage of this bill?
There are. I mean, yeah. Go ahead.
Well, you mentioned a lot of RTO businesses use debt to buy their inventory or run operations. There was a limitation in place that could disallow interest expense. It's still there, but they've made it a little more favorable.
Yeah, so the
Yeah, because I have no idea what we're talking about.
The nerdy code section is 163 little j, but what it did was limit the ability for businesses over a certain gross receipts cap, so the bigger businesses, not the smaller, to disallow interest expense above a threshold. So let me clarify what that means. You've got taxable income for the business, and what this law does is it limits your ability to deduct interest above 30% of what they call adjusted taxable income. So what is adjusted taxable income? Well, you start with your taxable income, and then you add back interest and income taxes to get to an EBIT number.
The EBIT number.
Earnings before interest and taxes.
That's the EBIT number, guys. There's an elusive name out there for it. That's it right there. The EBIT I see on all my paperwork.
So they limited it to 30% for the last few years of EBIT. What this law did was it adjusted the definition of adjusted taxable income back to where it started in 2018, which was to EBITDA, which added back depreciation and amortization on top of that,
Okay.
which is huge for rent to own.
Yes, that I do know.
Depreciation is a huge number, so that really increases that adjusted taxable income threshold. So 30% of that is going to allow a lot more interest to be deducted for that business than what was normally allowed.
Well, guys, I would tell you right now, if you haven't started on your tax preps or you don't understand it, please reach out to these guys because they're going to tell you there's another way to do it, and hopefully it helps all of us out in the time to come. So
the other thing I will mention about this big, beautiful bill is for rent-to-own employees who earn overtime. There's an exclusion now on overtime pay up to $12,500.
$12,500.
So now your employees who earn overtime can exclude $12,500 from their taxable income for overtime pay.
Up to a threshold.
Now, the part that's excludable is when you think of time and a half being overtime pay, it's just the half portion, not the straight rate portion that qualifies. So they have to be under a certain gross income threshold, which is I think in the mid 150s.
I was going to say 150.
Around
Okay.
150, but for those people that are earning overtime pay, there will be a new form that will allow them to deduct some of that overtime pay on their tax bill as well.
I know a lot of employees are really going to enjoy that part as much as humanly possible. I can tell you right now, there's so much that you guys understand about this business that I just don't. And I really appreciate that you guys are even here because Lord knows it's not an operational thing. And I think that sometimes beneficially we forget. And there's guys like, even like myself, that are guys out there who just want to open a business. They want to get in there and they want to get it open. But there's so much behind the scenes of understanding your business, how to run your business, how to be successful in your business that it's not just counter work. How you spend your money, where you get your money, whatever you do with it is just as important as saying hello when they first walk in the door and making sure that they have the greatest customer experience you can give them. And learning that over these last few years has probably been the biggest thing that I can say is there's so much in front and behind the counter that I just didn't know. And so, being able to talk to you guys about that and understanding it it's a huge advantage for everybody who doesn't know. You got to help me out here, though. I got to stop it for a minute. I say RGCO because I just cannot say it the right way. Help me say it.
Rivero, Gordimer and Company.
Gordimer. Okay, so it's Rivero, Gordimer and Company.
Yes.
And where did the RGCO come from?
So it's just their initials. So basically, we got tired too of saying Rivero, Gordimer and Company everywhere we went, and the person on the other end of the phone saying, "Can you spell that for me?" So we basically, when we rebranded logos and everything else, we just sort of shortened it down to RG&Co.
Okay.
It just seems easier.
As I was coming through the offices, I seen all the, I believe it says shareholders on there.
Yeah.
And I see Mike's face on there. It's like, okay, well, I'm in the right spot. How many of their, is it?
We have 10 shareholders.
10 shareholders.
Yeah.
And
yeah. So I'm one of them. Alicia is a senior tax manager. So she's one step away from being on that wall.
are you gonna be 11?
We don't know yet.
She's like, I can't speak on that just yet. I mean, it's.
She will if she wants to be. Let's just put it that way.
There you go.
That's
there you
the
go.
question.
You know, we were going through. APRO had done a lot of these webinars these past year or so. There was a lot of people talking about a lot of different things. There was a part where you actually spoke on the valuations of businesses in the RTO world and how they can vary and differ. What are some of the things, and I'm not going to go into like the corporate world because that's just crazy. I mean, you got 1,000 stores. I'm not even going to ask that kind of question. But what are some of the biggest things that cause a different valuation from one RTO company to the next? What are some hot points that you can say this matters most? Whether it be, you have 3 vehicles, this guy has 1, this guy has more customers than you do, you have customers, but this guy has agreements or revenues. I mean, what are the huge differences between saying this company is worth it versus this one needs a little help before you buy?
So I'm going to back up a little bit before I answer that question, and sort of start from where we started with that. So a few years prior to this, I was asked to host a panel at RTO World with panelists that included people like Trent Agan, Michael Bennett. We had our valuation and advisory person there as well. This may have went back to like 2021 because I think it was when we were here in Tampa. That being said, the panel was on valuation and buying and selling businesses. And so we had dealers and we had professionals. We had people that have done it from buy side, sell side,
all over.
Yeah. And when I first got started in this business, what I learned was pretty much everyone's exit plan was Aaron's or rack. Right? That was everyone's exit plan.
I'm going to make this as big as I can so that somebody buys me out in the end.
Yeah.
Almost like a house.
But there was also that state of mind that I know they'll buy me. So I didn't have to really worry about how I was going to exit. I know they'll want me and they'll take over my store if I want,
Right,
so
right.
That stopped at some point. That stopped. And so then everyone sort of became, all right, who's going to buy me? Who's interested in buying me? What's my company worth? And so I think there was more talk about that. Now there's still the swap stores and different things going on. But that panel sort of drove some discussion, I believe, for dealers about their own exit plan and how's that going to transition. So we started talking about not just selling off to
what are you really
a
worth?
Competitor, but you can also transition your business to key employees or to a family member. We've got some second generation owners in this business, as you know, who do very well and have grown up in this business. So, it's sort of all of that is what we wanted to discuss more, is how can you transition and when should you start transitioning? Not just the what's my business worth, but we also talked about the key components of how that gets built. So Charles Smitherman came to me, late last year and talked to me about doing one of these APRO webinars and said, hey, I really want to create a resource for APRO to have to where people can go on who are members and access information on valuation and on exit strategies and on that. So I want you to kick it off with another discussion on that topic. And then I want to put something into our platform that people can draw from resources. And that's where we're at now is we've sort of taken the slides from that presentation, built out an educational draft, and we've had different iterations of it and drafts going back and forth. And I think it's now come to conclusion to where Charles is basically about ready to finalize it and put it out there.
I'm going to tell you right now, as he was talking, I had like 3 pages of notes. And I was like, I cannot write this enough. There's too much for me to put down on this. It was just so much that you covered on there, and it was pretty in depth. I mean,
yeah, it is.
You got to know your business.
It is, and it unfortunately it's pretty in depth, but it's still very brushstrokes. I mean, it's high level discussion because when you actually get into an actual business valuation, so much more detail goes into it.
Oh my
than what
God.
I discussed.
Now I'm kind of worried to find out what are those major things that make you know, they're going to be like, but that's not what I know. You know, is these things that make these differences, you know, and I guess it's going to be, for a lack of a better term, a very broad coverage of what these topics might be. But there must be some difficult conversations that must be had when you have somebody who's like, I'm ready to get out. I've got, you know, how many ever stores, and I think they're worth this, and well, let's just kind of cover the bases, because you might not be.
Well, the first thing I tell people is I've been through a lot of M&A transactions, both buy side and sell side, not just RTO, but many businesses. Never once have I ever seen in any purchase agreement an allocation of purchase price to sentimental value. So
that's not the big beautiful bill. Hold on.
So I get them over the hurdle really quick that your sentimental value is worth zero to a buyer. Right. So let's talk about what they really want to buy. They want to buy cash flow. They're buying a cash flow stream. So when you get into, are they buying assets? Are they really buying delivery trucks? Are they buying inventory units? They're buying all of that. They're buying a recurring revenue stream, but really they want to know, how much cash flow is this thing dropping, and what am I willing to pay for it? And that comes back to risk. How much am I willing to pay for it? That risk drives the multiple. So what I try to explain in these discussions is
we're going to discuss the multiple word, because that is a big word in rent to own. I would tell you, even when I was like a wee lass learning everything, there was the word multiple that came out, and I was like, what? What did I just hear? We're going to go back to that, okay. but so all of this helps fuel the multiple of the sale. We'll talk about that. And so I'm sorry, I didn't mean to cut you off. Just that multiple word, it's one of those catchphrases, one of those terminologies that a lot of people they're going to hit me back and go, that's where the multiple came from. Yeah. That's what it is. Yeah. Josh, just so you know, this is for you. So,
I mean, that's really what drives it. And so what I try to explain to them is where to start. And it starts going back to the EBITDA discussion. You know, what is EBITDA? And then how do we go from EBITDA to free cash flow? And once we know free cash flow, which basically means operationally what the company is driving, once I normalize everything. So every business has different things in it that run through the company that may or may not be an expense item of what a buyer may have. So for instance, if you're an owner, you may have a very inflated salary. You may have your car on there, your wife's car on there, you know, your kid's car on there. You may be running some stuff through there. It might be more personal than business. All of those things, they sort of look at the numbers and say, well, how do we flesh out what this P&L is going to look like if we take it over? And so you sort of normalize those earnings and adjust it all. Where rent to own is a little difficult is you have to account for the differences between the depreciation cost of goods, which is a non-cash item. So I've paid for it, but last year, but now it's hitting my books this year in my cost of goods.
Right.
You know, so you sort of have to flesh out those differences with add backs and subtractions for what am I really paying versus what am I expensing, and sort of normalize what that cash flow is to get to free cash flow. Then once I have free cash flow, I basically apply a calculation to that free cash flow, which you refer to as the multiple. We refer to as an inverse of the discount rate. So it gets discounted based upon some present value, what somebody's willing to pay now for a future cash flow stream. So am I willing to pay $1 today for the right to earn $3 over the course of the next 5 years? And how risky is that dollar today? That risk factor drives the multiple. So whether it's a multiple of 4 or 5 or 10 or whatever, that multiple is driven based upon their determination of how risky you are.
Now, when you say risk, are we talking about, because I'm trying to put my brain around this, and I'm sorry, guys, I'm nowhere near on that level. But when you say risk, are we talking about how many customer returns that we've had in the last 6 months on average, how many agreements lost, or how many agreements gained, or
little different. So let's start with if you were
Hey everyone, it's Pete Shau here from the RTO Show podcast, and I want to tell you about a company that's making a real difference in the rent-to-own space, Wow Brands. I've seen firsthand how they approach marketing, and let me tell you, it's not just about ads. Wow Brands builds complete digital ecosystems designed specifically for the rent-to-own industry. Their e-commerce and lead generation strategies are built to bring in qualified leads. And did I mention that they are actively working with the rent-to-own industry while also being members of APRO and TRIB? Listen, these folks are passionate problem solvers. They don't just slap something together. They design, build, and scale the kind of digital retail tools your business needs and your customers actually want. So if you're serious about growing, reach out to Wow Brands at wowbrands.com. I trust them, and I think you will too.
If you were going to take $1 and invest it into a treasury bill, very safe investment. You're not going to lose the money.
Absolutely.
You're also not going to have a big return on that money because there's no risk.
Right.
But it's safe. You start there. All right, so what is the risk if I invest in a treasury bill? What is the risk if I invest in a publicly traded company? Publicly traded company has a readily ascertainable market value on any given day at any given time.
Right.
I can point to Amazon stock right now and say, there's the stock price.
That's what it's worth. Right.
That's what it's worth. And that's what I can sell it for. You can't do that with private companies. There's no easy market out there. So they define risk with other things. How does it compare to a treasury bill? What is the risk that this recurring revenue stream doesn't exist tomorrow? How strong is my employment base? How strong will the owner leaving influence my business tomorrow? All of those things they look at and sort of build up levels of risk based upon safe investments versus publicly traded companies versus non-publicly traded risk versus now you've got an industry risk. What is the industry risk within that private industry?
Who puts together this risk portfolio? Is it you?
Valuations experts, they all do it. I mean, but if you give 10 business valuations, 10 valuation experts a set of numbers, the same set of numbers with a 3-year trailing, set of books, they'd probably all come up with somewhat of a different range based upon how they determine what that risk would be. And that's looking at comparable sales. That's looking at what's going on in the market. That's looking at interest rates. That's looking at all of those external forces that can drive a riskier investment.
I'm curious because this is something that I do, right? And I'm trying to dumb this down for myself here, but I just want to talk to you about it. So like, if I want to get my AC repaired, I'll call somebody. And they come out and they'll say, hey, $500, $1,000, whatever the case is. Okay, I'll call you back.
I just did that this weekend, as a
that
matter
was
of fact.
And I'm going to call up somebody else, and I'm going to tell them, hey, this is what's going on with my AC. Come on, take a look. Oh, it's going to be $400. Oh, it's $400. Give me a workup. This is what you're going to do for this amount of money and yada, 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 right? I'm going to call somebody else. Usually we have the rule of 3 in operations. The rule of 3 says you take what you see out of 3 and you kind of figure it out. Is the cheapest price the best? Or is it the guy at $500 because he's going to give you $100 worth more of value to not have to come out again, right? Because you got the cheap guy, you've got the middle guy, and usually you get the one guy who says, yeah, this is going to cost you $800. Why is that? Well, this is out now. That's going to go out in 3 months. And if I have to come out here, I'm going to charge you $175 for both visits. You can just knock it out now and be done with it, and you won't see me for another year, and I'll give you a year's warranty, right? Whoa, you just blew me out of the water now. Valuations, because they're so different. Does somebody go, hey, man, this is the valuations that they're giving me. They're saying that I'm worth $500,000, $600,000. Does somebody go out and say, hey, I want Alicia's idea of what my company's valuated at versus Mike's, and then work it out in between? Or is it company standard, whatever I go with you and you tell me it's worth, and then the buyer has their guys who do valuations, they said it's worth it, and we kind of figure it out there?
Yeah, the buyer will generally hire a company like ours to do what's called a quality of earnings. So even if you had a valuation report done as a seller, said, okay, my company's worth $1 million, the buyer's just not going to take that number and say, okay, I'll buy you for $1 million. They might, but there's negotiation.
Right.
They're going to come in and do due diligence. They're going to look at your numbers and put together using a professional firm like ours, a quality of earnings, which basically looks and says, okay, what is real here? Is the revenue real? Are these contracts good? Are these customers paying?
Right.
And they'll look at samples, they'll look at trends, they'll look at trailing 3 years of activity. And so they'll determine and give a report based upon, all right, we've tested these things. We've looked under the hood. These numbers are good. These contracts are good. We pulled the contracts. They're real. So, it's not an audit and it's not a valuation. It's a quality of earnings. And so it basically presents on what is the quality of the numbers that they're presenting to you based upon what you feel you're going to take over with your purchase price.
How long does this usually take?
Months.
Really?
Yeah. It takes 30 days minimum, depending on the records that we get. Generally, getting the information to do the work we have to do is the hard part.
Alicia, what's something that when you started out and you found out about rent to own, it was like, this is way different than when I started. This is a different way of looking at business than I'm used to.
Yeah.
Come out of the classroom and now here we go.
I think the inventory is the biggest difference, how you treat it.
Because it doesn't just leave
Yeah. And it could come back.
and leave again.
Yeah.
So if you, over the years, now that you're here, now, would you say that you have a lot better grip on rent to own than you did before? And how long did that take?
I mean, I've basically been in it for less than 1 year at this point.
Oh, okay.
So.
All right. Well, then how are
about
we
1
12
year.
months
Yeah.
later?
1 year.
Yeah.
Yeah.
Another
she's
month.
learning. So our RTO committee here is made up of, we got about 6 people. Not just me, not just Alicia, but we've got others. Some tax, some audit, some valuation advisory. And we meet every couple months to talk about what's going on in the industry, what we've learned, what's going on with our clients, what services we need to be doing. And we collaborate on those things. So that she is continuing to learn more as she goes. But
learn more at
it's
all
fairly
the
new
shows.
to it in all respects of what we've been doing here as a firm for a while. She's only been with us 4.5 years, but really stepped up last year to get involved in rent to own when we had personnel departure, and stepped up to basically say, hey, I'm willing to learn this and help out and take over some of these relationships.
Oh, welcome to the RTO family.
Why, thank you.
So, one of the things that I've been asked, and I'm going to ask you because you guys see it on a whole different level than we do. Some people have said, you know what, rent to own's fine. The economy is just going through what it's going through. It is what it is. And I've heard people say, oh my God, the bottom's going to fall out. Oh my gosh, what are we going to do? Have you seen a change in the rent-to-own industry in the last few years, depending on what's going on? It's like far as maybe consolidation?
Sure, but I've always felt that the rent-to-own industry, I hate to use the word recession-proof or economy change-proof, but it somewhat is insulated compared to other businesses we work on. Okay, so you got to remember, our firm doesn't just do rent to own. It is a very full service firm doing all walks of life and all industries. So compared to other industries we see that very much get impacted with ebbs and flows of economy, rent to own I've seen is impacted less. And I'll say that, it doesn't mean the numbers aren't going up or down and interest rates or, but generally speaking, your clients, customers, may change. If someone has an economic shift in their life where they were a retail buyer and now they want to look at the rent-to-own transaction, or they're just not as confident because of their job status to go out and want to buy something, they want to rent something that's less risky, going back to that word. So your business may shift a little bit, but less impacted, I think, by the economic ebbs and flows as others. Now, when you're in the rent-to-own business and you don't see everything going on outside, you probably don't recognize that because you're like, okay, my customer count's down, they're paying slower, all of that stuff. But compared to other businesses, it's less. Does that make sense?
Well, I mean, you're always looking for the benefits. right? If I have a car business and there's a car boom, I'm doing well. If there's
Yeah.
there's no car boom, then you got to think. So you got to always look at the bright side, and you always want to manage the risks. Right now, I think that the economy is going through whatever it's going through, and it's going to be hard. One of the things that I wanted to talk about was, as this looming idea of tariffs come up, does that play any difference in the taxes of a rent-to-own company, or is it just your cost goes up with what comes in, and that really doesn't affect the tax side of it at all?
Your cost goes up, so should your pricing model.
Well, it has to go up.
Has to.
Yeah, it
right?
has to
You
go
got to
up,
pay for that
unfortunately.
somehow. So from an income tax perspective, it doesn't drive any decisions we're not already doing. But from operations, it does, because it does affect your pricing models and how you're looking at what you have to price product out at, and when you have to order so that it shows up when you want it to. You
Absolutely.
know, all of those things. The industry itself, though, is, and I keep saying this, has shifted. You guys have had to learn how to do online sales. You've had to learn to do different things post-COVID. You've had to go back and learn to rent and collect, whereas a few years you just had all this economic stimulus money that was floating around out
God,
there.
it was such good times.
But
times.
But you're also experiencing labor loyalty issues, just like the rest of us are.
Yeah.
And so constantly having to retrain people coming and going. So you're experiencing some of those things too to run your own companies. And I see that rent to own no different than others. You've got good operators and you've got less involved operators.
Yeah,
and it's
that's
very
good.
much.
Yeah.
You've got to be as an owner and a manager. You've got to be heavily involved in your business and know your numbers.
Yes.
You got to pay attention to it.
Well, I've seen them both. I've seen guys that are at the front counter every day, and I've seen guys that they like to drive. They like to drive off the lot at 12 o'clock in the afternoon and not come back to the next day. It just happens. When we're talking about, because you were talking about the exit strategy, I want to build this. I'm going to have 3, 4, 5, 20 stores, whatever the case is. I want to get out. And now the big players are not in it, at least not the way they were. Because I remember there was a Growth Cycle or Rent-A-Center, and I'm with you on it. They bought anything that was alive. I'm not that much with the Aaron's, but I also know another couple of companies that were like, hey, we'll grow. If it has a rent-to-own moniker on it, I'm going to stick a couple of trucks and a few guys in there, and I'm going to see if it works out or not. They were buying anything. Fast forward to today, they're not growing like they used to be. Not saying that it's a bad thing, but they've decided, hey, we're going to work on our own. We're going to grow this organically. If we open it up, we're either going to do one of two things. We're going to evaluate and make sure this is a 100% good idea, or we're just going to open up ourselves, right? But the exit strategy has not gone that far. There are people that are still trying to get out of this and trying to figure out what they're going to do. What, as you guys have seen, what are the more active buyers now? Are they big companies? Are they investment groups? Like, who's buying rent-to-own today?
You can use the term private equity. You can use the term venture capitalists. You can use the term just regular entrepreneurs. We've seen an influx of people that weren't in the rent-to-own space come into this business that are interested in buying cash flow models. Rent-to-own is a cash flow model business. It's not real estate where you're buying that building.
Right.
You're buying a cash flow stream, just like I talked about a moment ago. So you've got groups out there that may be having a portfolio of real estate. They may have part of their portfolio in other franchise groups like Popeye's Chicken or Dunkin' Donuts. And they learn about this rent-to-own business. And they go to a show, or they go to a franchise show, and they learn more about it. And so they start looking at the numbers. And so they have made an influx of investments into this business as well, to where they may take over control, or they may take a back seat as far as how much they're involved in the day-to-day. Most of the ones that I work with and have taken over majority control. They basically bought the business effectively, and taken over stores or groups or chains or whatever. So, and that's what they're doing. So you don't have the Racks and Aaron's and different groups like that, the big companies that are just taking on everything, but you do have other investment groups But that has slowed down with interest rates rising, because those groups do come in with plenty of capital, but they also want relationships with banks. So we'll transition to that discussion. Banks don't really like this business.
So I hear. So I hear.
And I know you've had some other podcast people on here before and had the very discussion. But that being said, we all know that. We all continue to search for banks to get them comfortable with this business. Those investment groups do the same thing. I have plenty of discussions with banks all of the time about this transaction, this balance sheet. Why is there no accounts receivable? Why is there not inventory? What's in my cost of goods sold? I don't understand this at all. It doesn't fit into my retail model at all, and it's broken. So we have to explain that to them all the time. And so they go through the same thing. So as interest rates rise, risk becomes heavier. Banks don't want to lend out, especially to a business they've never lent to before. So you've seen a slowdown in those transactions.
I have.
The past few years too. And so it's causing some of your aging dealers that do want to exit to look at other things. What can I do? Can I transition this? Can I do I have a family member that's interested, or son or daughter that wants to take this over? Do I have a key employee? How do I do that? And so that requires them to start planning a little bit more in advance. You can't just wake up one morning and say, you know what? I want to retire tomorrow.
I'm ready to get out.
I'm for sale. Let's hang up for sale.
Somebody buy me.
So you got to start planning in advance. And to do that, you've got to start looking at the numbers and some of the things that we're talking about to plan for that. What's attractive to a buyer? And now scrub your own numbers. Let's look at your numbers to see what your value is today and what you can do to improve it to make it attractive to a buyer. Or if you want to transition to someone else that can't afford to buy you out today, maybe you can do a seller note and bring them in over time to where they can buy in slowly to take you out over time.
Wow.
So there's all of those different things that we've had to do to plan for different types of exits depending on what someone's faced with.
Usually when I see Mike, he's just talking about the weather. You get him involved in taxes when he's just coming out. You see it coming out, right? You see it too. He's like, but then he just gets into it. That's what I love about you, Mike. You really believe in this, and I really appreciate that. Talking about
this is going to be your least listened to podcast.
No. Listen,
it's boring.
Everybody needs to know what they're worth. Everybody needs to know how to get to where they're going. I mean, the yellow brick road wasn't an easy walk, but it was there. It's something that we got to do. We've got to face this person at the end, and the end is always, what are you worth, and what can you make happen? Talking about advice, you are on the April Vendor Advisory Committee, right?
I am.
And so, what does that involve? Does he require help on that? What do you do there? I mean, you're doing this on the show, and I really appreciate it because there's a lot of advice that you guys are giving, a lot of knowledge that you're dropping here that some people just don't know about. And I'm telling you the truth, I can 100%. And from multi-unit all the way down to the guy standing behind the counter, they just don't see this type of the business. Now, you are going to have listeners going to be like, that's very important to me. You're going to have listeners like, you know what? I might skip that one because I don't know anything about taxes. But if anybody wants to know, it's hugely important to figure out what is important. And as you were advising, being a part of the Vendor Advisory Committee, talk to me about that. How does that work? APRO is a big part of our industry, and so are you.
Yeah, and so kudos to APRO for having the Vendor Advisory Committee, but really what it is, it's a forum for vendors to sit down and talk about what they can do to help the industry, how they can get more involved, to become more educated about the industry and talk about what's going on, but also how to make the shows better. Because when you talk about meeting of the minds, when you talk about RTO world, it wouldn't happen without the vendors. So this is my shameless vendor plug.
And here we go.
All right. The money flows from the vendors that help underwrite the cost of all of this stuff. We know that. So you got it. Without vendors, there wouldn't be this business. Right. And so whether that's product or service vendors, and so you got a mixed group of both that sit on a committee that talk about what we can do to make the shows better. And it's everything. I mean, it's everything from, is the conference room going to be big enough? Is the showroom, the trade showroom, going to be big enough to the cost of Wi-Fi, or how do we get rugs in there, or shipping and freightage and all this stuff. The freight piece is huge when it comes into who we're going to deal with, and are we dealing with a union-based group when we get there or not, and what's the cost of all of this stuff going to be? And so, it's everything that the vendor advisory committee talks about to help educate APRO, and even Dennis is involved too and listens to those things.
We're talking about Dennis Shields of the Trib Group.
And so what can make these shows better? And it takes a village, and the voice of the vendors is a big part of it.
We're talking about new people in the village. It's been a year. You said now it's been a year. It's coming full circle. We're going to have a birthday celebration sometime soon. How has been your venture coming into this? Because I know for a fact that this business is not as old as some other ones, but you've got some guys that have been doing this 40, 50 years on the top of that ladder. And they know a lot of people, so it's almost like a family thing. And like Mike said earlier, I came in, it took me a couple years before they recognized who I was and they actually said my name. But now that you've been here for a year, how has that venture been for you?
I don't think I've had any issues coming in, but I also have a family member that's already, been invited in, that's showed me around, introduced me to everyone, so everybody's been nice. They come to me with questions. It's not like they just go to Mike.
Are you taking the Jamie Slatton kind of approach? Here she is.
I tried, but what I really want to hear her say is when she first started getting involved in this business, her mindset of this whole business was more stereotypical.
Oh, yeah.
So why don't you discuss that and how that has changed since you've got to know the folks in this business?
It is different. It is different.
Yeah. So I don't remember my initial comment. Something about how I kind of feel bad for the clients, customers, because they're paying more for the product. But Mike educated me, like, this is the only way that some of these people can get that product. That's how they survive. Is that where you were going with that?
Yeah.
Well, usually that comes from the operations piece. Usually that you see that in the needs, and when you're talking to the owners who are now playing both sides of the fence, right? They're paying I've got to buy this a certain way. I've got to stretch out my funds. I got to make sure that I'm paying the labor and the taxes and the big, beautiful bill that comes along with it. But they also know what it's like to stand in the front showroom and talk to a family who just has needs. Yep. And their needs sometimes outweigh their ability to pay for those needs. And it's that relationship and how you're working it out with your clients to make sure that they 100% are involved with you, you're involved with them, and then that transitions into a cash flow that we get RGCO involved in, right? So it's that whole runaround. And if you've only been here for a year, hold on, because there's a whole lot more.
My opinion has changed a lot from
there's a whole lot
first
more
day
coming.
When I heard I was going to kind of be on this industry.
Yeah, I mean, there's a whole slew of services that the rent-to-own industry provides their clients, their customers, beyond just taking payments. If something breaks, it gets replaced. All of those things that you don't get with the retail transaction.
It's about information.
And so it's totally different business. And I think educating her for me has been no different than I've had to do educating banks and other people, even investors that want to get involved in the business. For instance, some of the franchisors that we represent and work with, as potential franchisees become interested in this business and are looking at the business, they will have them set up a call with me to talk about the numbers, to talk about that piece of the transaction, and help educate them on the business as a whole, because they're coming in with a different mindset of things that they've heard or read about or whatever, and they just need to be educated. And that's where APRO and Trib become great, and this industry is wonderful, sharing that information to educate people and the masses about why this is a great business. It serves probably an underprivileged group that wouldn't have access to things otherwise.
Well, I was just talking to Dennis Shields about that. It's $1 billion industry. Okay, we're knocking on $9 to $10 billion. There's a lot of help to go around. Yeah. It's needed,
right?
And we love to serve our community.
And you read about that with the stories, the giveaways, just during COVID, the laptops that were going out to schools and to kids that had to be now homeschooled and things. I mean, it's endless when you read about what's going on because of your customer relationships and how entrenched you are in your own communities. You're living in those communities. Your kids are going to school in those communities. They're going to school with those other kids. So it's a different relationship. And I think we've learned that. I've learned that over time, and she's sort of on the cusp of seeing all that too.
I've learned it.
Yeah. So it's just where we are.
So as you're part of this vendor committee, you're also part of FRDA. Now, the FRDA is a Florida Rental Dealer Association where there are RDAs all over the country, right, for different states. But you're part of the Florida Rental Dealer Association, and you guys were just recognized. How important is that to RGCO? How important is that to Mike and Alicia to be recognized for your involvement in the RDA?
Well, we were able to become title sponsor this past year, which was great for us. It was great publicity. I never thought our firm would be able to be title sponsor at any of these shows. But
it was great for Mike's ego.
It just worked out.
Well, listen, I mean, you guys have been doing this a long time. I mean, RGCO's been around for a while. This isn't a new transition. So it really is kind of like one of those milestones where you can say, I've lasted here long enough. I've been part of the industry long enough to be seen as somebody to lean on.
Well, in 2021, our firm was recognized as the vendor of the year. And that was really cool because I never thought that we'd be on that stage getting one of those awards. And that was an honor. And then to become a title sponsor for any event, was to me was awesome. And to do it here, the Florida show, it's done locally. We looked around the room that day, and everyone in there, every group represented in that room that day was clients of ours except for one. It's pretty amazing.
That's
when you think about the impact that we've been able to accomplish with those relationships. So when we identified that, it's like, why wouldn't we, sponsor if we have the opportunity to? And cost and everything comes into play for it, and it was doable for us this year, and we were glad we could do it.
Well, at least it wasn't during tax season, right?
True.
So going back a little bit, we were talking about some of the things that, the valuations, the EBITDA, who's going to buy, who's not going to buy, things that are valuable and things are not. What are some of the trends that you're seeing as far as in the RTO world, since you have that many people involved in RTO and you see a lot of the back end of what's going on with the dollars, with the income, with the revenues? What right now is kind of like that? What's happening with the profitability and cash flow? Is it that we're facing, and I guess I should say that interest on taxes is actually going down, right? As of last that I heard.
Well, interest rates are
going down, right?
Correct. Yes.
So
that being said, I mean, you first have to look at where each dealer is in their life cycle. If they're in the first couple of years, they're probably not generating the profitability yet that they ultimately will get to. If you've been in business for 8, 9, 10 years, then you've seen the ebbs and flows that we've discussed. The good dealers will make money no matter what. They're just running their businesses very well. Okay. Do they have ups and downs? Yes, but they've generally established a pretty recurring customer base, cash flow. They've got their numbers down. They pay attention to their margins.
Right.
They follow the right KPIs and those things, and they pay attention to their business. Others that are still learning the business, struggle a little bit. This business is very cash flow, capital intensive. So you get into this business, you buy a unit for $500, you rent it. So you've paid $500 and now you rent it. You get $16 for that week, and it's out the door.
Yeah.
But now you got to buy it again to replace it. So you've spent $1,000 and collected $16. That's hard for people to get their arms around, right? And I'm doing this at a very elementary,
no, and that's exactly what
scale.
It is. But is that how the banks look at it and go, wait a minute,
yeah,
you've invested a ton of money and we're not seeing the return. The cash flow is way low for this. We're not getting $100 a week. We're talking about $16 to $25 a week on a regular stationary, and then maybe you get $35 to $45 on a motion, but like, what is that in comparison?
Yeah. So I know I'm using very vanilla examples and numbers, but What I've explained to people is, look, you basically before your second payment, you may have bought that unit twice, right? I mean, think about that. So you have to develop that customer base has to build, right? You got to get that BOR out there and increased.
Right.
So that being said, I mean, you've got people that stay on top of that and some that don't. It's been a little harder. I hear more complaints than the previous few years. The last few years have been a little tougher. You've had to go back to some of the fundamental rent and collect, training and just getting people in the store. And less people are going in the store these days. They're shopping online. So you've had to retool and retrain and develop technology and all of that stuff too. It's been hard, but it still will thrive. It's not going anywhere. I don't believe the brick and mortar stores are going anywhere. There's still a purpose. People still want to see what they're buying. And there is definitely a customer out there that does not ever go into any store. And that age is there, but there's still plenty that will and will want to. And I think the presence in the community, the storefronts in the communities make a big difference too.
I've got to say, we just hit the third word, or I should say numbers of the day. First, it was the multiplier, then it was the EBITDA, and now it's the KPIs. We're hitting everything today. What would you say is a mature store then? Somebody is saying, you know what, you're right. You start up, there could be a lot of startup. There could be another store, part of the startup, right? I'm 6 months in. I think I'm doing a good job. I want to add another store. Another year maybe goes by. But, I mean, that's a lot to take on. So what would you say is a mature standpoint? This store has been here for, and it does this and this on a regular basis, would probably happen around this year without a lot of acquisitions and changes. And busy season is about to hit hard. Q4 sales are ramping up, tax refunds are coming in Q1, and if your books aren't tight, you're leaving money on the table. But here's the thing, these benefits don't just happen. You've got to make strategic moves now to cash in when you file in 2026. That's where Rivero, Gordimer & Company comes in. For nearly 20 years, they've been the go-to CPA firm for the rent-to-own industry. They're not just number crunchers, they get the unique challenges of RTO, startup consulting, industry-specific tax strategy, succession planning, valuations, they've done it all. You've probably seen Mike Helton and Alicia Holloway at trade shows, or even heard them breaking down these new tax changes on the RTO Show podcast. Don't let Q4 slip away. Head to rgcocpa.com or call 813-875-7774 to schedule your consult today. Make the moves now that pay off later. Rivero, Gordimer & Company, because your accountant should know RTO as well as you do.
Yeah, I mean, what I've always heard, and I've never operated a rent-to-own store, so you probably know this better than me, but what I've always heard, rules of thumb, 500 BOR, 500 customer count, or $50,000 a month in revenue, or whatever that might be. So, I don't really know. I think it goes back to how big your store is. If you've got a store that you lease for $4,000 a month, it's going to be different than if you're paying $12,000 a month.
God, I miss those days. So, they're not here in Tampa.
No, they're not. They're not. And so, but it depends on where you're at, where you're located, how many of those numbers you need to cover cash flow. Because again, it comes back to the cash flow. And when you're monitoring those margins, and you look at, all right, my cost of revenue should be somewhere around 35% of my revenue. So I'm dropping 65 cents to my gross margin. And then I've got 25% going to payroll. And then I've got another 10% going to occupancy. By the time you look at those numbers and dwindle it down, how much is hitting the bottom line? So the hard part about this business is you have to pay attention to those numbers. You can only buy for what you can afford to buy.
Right.
But if you don't buy, you run out of revenue runway. Right? Because your stream dies if you're not buying. So it's that yin and yang between when to buy and how much to buy that you've got to control. Like Alicia said, the inventory. Understanding the ebbs and flows of that inventory and how much can I afford to buy. And that's going to ramp up as your customer count builds up. And then your cash flow is going to build up from there. So you have to start under a controlled growth scenario. You can't just go gangbusters.
Well, right. Well, there's a lot of people who've said a lot of things in a different way, but there's a curious comment. There's a curious thought It is cash intensive. I don't know anybody who hasn't said those two words when it came to opening up a rent-to-own store without saying it within the first paragraph. Yeah, it's a great thing. It's cash intensive. It eats cash. It will, you have to have a big lump sum just to start it, not let alone keep it going. But rent-to-own have people that are die hard in it. I know businesses who don't require a quarter of what it takes to open up a store, yet they love it. Is it really that advantageous to have a company that costs so much up front? And what does it give you in the back? When you see those numbers, is it really something that somebody's really like, is it the one store that can work off of 65 to 75,000? I would love 50,000. 50,000 was a long time ago.
That was a long time ago. Yeah.
But
I mean, even $1 million a year store now isn't what it used to be.
No,
right?
well,
It's not.
it's funny. I was having a conversation with a couple of people at that. The $1 million store now is almost like it's either $1.5 million or $2 million.
Yeah,
the $1 million store is gone out.
Correct.
It's gone.
Correct.
And so that's always the big question: is with all that it takes, with all the money, with all the finances that it takes, is it worth it? I would hope so. But I don't know anything about that side of the business to say. I only know about my bonus checks and if I'm working and doing the right thing, right? Which I guess we can depreciate. No,
I mean, it's a valid question, and you're right. Most people in this business love it. They love what they do. They came up in the business or were a delivery driver, was a store manager, was an operating district manager, something, and they've come up in this business, and that's what they know. No different than me. I don't know what I would do if I did something else than what I do. It's
no basketball.
Well, I'm still waiting on the NBA draft call.
All right.
Yeah. So I don't know that that's going to happen at this point in my life, but I think it's a very valid business, from that perspective, and it does drop money to the bottom line. You just have to pay attention to it, and like I said, we here take a very balance sheet driven approach. If I'm a store owner, do I just want to look at my revenue number and my bottom line number and call it a day? No, you have to look at the balance sheet. If you're not reconciling cash very regularly, daily, twice a week, weekly, don't wait monthly, don't wait quarterly. You got to do it on a regular basis. That's a little takeaway that some people should do, especially, the bigger you are, the more you got going on, you have to pay attention to the cash at any level. Reconcile cash. Tie out your balance sheet inventory to your POS. Make sure those ins and outs are happening and being recorded properly. Once your balance sheet is correct, then you can trust your P&L more. I can't trust your P&L until I know your balance sheet is tied out.
Right.
Where we see a lot of discrepancies with the numbers we see is the POS numbers don't tie to the balance sheet. So it's saying
Mike's being so nice right now. The discrepancies that we see. Don't be late. Don't be late doing this.
We see that a lot, though, and so you got to stay on top of that. And as you make those debt payments, break out the principal, break out the interest, and so you have to pay attention to that. And everyone's got AP. Everyone's got unpaid invoices that they've got on their books that's been booked into their POS, that's hit their balance sheet. And now you've got this difference between what your accounts payable is and what your books say it is. And so, again, if your balance sheet is not tied out and correct, I can't trust your P&L.
Right. So, going back to the big, beautiful bill, because we're talking about money today. We're talking about where you are, paying your bills, making sure that you're understanding your P&L, your G&L, and everything in between. Was this bill helpful? What does the outlook look like in RTO in the next 5 years because of the changes of this bill? Is it a better? Is it not? It's no big deal. It's not a big change. Is it, oh my God, run for the hills, find some investment company to buy it, call RGCO for your valuations, and boom, get out from under it? I mean, what do we see in 5 years?
It's helpful.
Yeah.
It was helpful.
It's helpful. But again, I throw a little caution out there that, and I've had this discussion with clients, is you don't have to take bonus depreciation. Some of the biggest tax problems I've seen with RTO dealers in this business is they took bonus depreciation and now they've got a big tax bill on the back end. And so they They want to exit. They want to sell. They want to get out. They want to do something, and now they've got this.
And here are these lingering bills.
This deferred tax liability that's out there that bonus has created. Bonus is beautiful if you're paying for it with your operating cash. If you're using debt dollars to fund inventory purchases and driving losses to your tax return that you're offsetting other income with, now when that turn happens and now you're generating the profits on the backside, you've got the taxable income and you're paying off the debt. So you have no cash to pay the taxes. That's where it becomes problematic. You have to monitor and plan for that flow.
And then that changes the valuation.
Not necessarily. No.
See, you see how it is. I just don't know.
And these changes are only permanent for as long as certain governments are in place.
Yeah.
So they say it's permanent, but it could change the next election.
I will tell you, buyers love this bill because buyers are going to look at this like, look, I can buy this RTO company. I can get all this bonus depreciation in year one that's going to help underwrite basically the cost of this business for me right out of the gate. I'll deal with the taxes on the back end. I'm not worried about that. When I sell, I'll have enough cash to pay the taxes. I'm not concerned. So will that help M&A potentially happen? Yeah. Is it good for the industry? Yeah. Do you have to go into it with a mindset of understanding that bonus depreciation creates big differences between your book numbers and your tax numbers? And the people that elect out don't really have that volatility. Their tax numbers are pretty similar to their book numbers. So planning for taxes is pretty easy for them. They look at their P&L and say, okay, that's where I'm made. When you're in bonus depreciation and you're looking at your cost on your books, that doesn't even come close to representing what your cost may be for tax purposes. So it requires basically keeping track of two sets of books. It becomes a little more costly. It's harder to track. It's more work on our end to deal with that. Not saying it's a bad thing. It just is what it is. And so you have to plan for that business decision.
Is this bill too good to be true? Is this one of those bills that are too good to be true? Somebody else comes into the office later on and goes, yeah, that was wild ride. Let's get back to normal business. Or is this something that can actually be worked with the economy and the American people and say if somebody else comes, and this is thoughts. I'm not saying that this is or it isn't. But if somebody comes in and says we should just keep working with that. Because, sometimes some things are too good to be true.
I'm not going to get into politics. But I can tell you, to Alicia's point, if the office has changed, would I expect some of this stuff to go away potentially? Yeah.
That's kind of what I expect. Just a thought, And you know what they say? I mean, you can't please everyone all the time. It just doesn't happen. Hopefully, moving forward, regardless of who's in the driver's seat, we stay on a course for pushing the economy for growth. We need that. I don't care who you are in the world. We need that, especially in America with the American dollar under fire as it is right now. We need it in any way, shape, or form. But we won't get into that part. We're not going to get into that part.
I mean, one piece of this bill I will mention that they did make permanent, to use her term with air quotes, permanent. Nothing's permanent.
As permanent as Congress allows it to be.
But it's not cliffing because this one was supposed to go away after next year. The qualified business income deduction, QBI, Section 199 Cap A, which is basically 20% deduction for your pass-through entity income. So basically you're taxed on 80% of your pass-through entity, which is an S-Corp or partnership, instead of 100%. So RTO businesses qualify for that QBID deduction. And so this was made permanent. It's not going away. It's only permanent until the next change, but it has been extended. Let's just say that, which is a great thing for this industry as a whole.
Alicia, I just want to ask you a question. If you ever do anything, does he refer back to the manual? On page 49, subsection 3D, this is what it says that you should.
He probably could.
I love it. So, listen, you guys have been amazing and kind of just being able to put this in a perspective that I think I or other people that are listening to this can understand, because there is a whole lot more that I'm sure we can get into. You didn't see it last year, but so Mike comes into the RTO Live event And we have some people talking. It's nothing real big. There was a lot going on, right? So they stick us in this back room, which is okay. We're talking about it, and then Mike comes to the mic and he just drops this a couple of lines on us, and we're like, Mike, we weren't ready for all that, Mike. He has a way of doing it. We loved it though. It was great. So real quick, I got some rapid fire questions for you guys. Should we go one at a time, or should we do them both and you guys answer them both, or should I go one and then one?
Oh.
You got some answers ready. He's ready to go.
Whatever you want.
All right. So, Mike, what's the most surprising thing you've learned about the RTO industry in the last 17 years?
Oh, the camaraderie. As I mentioned, just how everyone interacts and talks. That's the most surprising thing I've learned about the industry.
Almost every time I have a podcast with somebody who's been here for a long enough time to say it, they always say that.
Yeah.
Whether it be Tissot, Shields, Charles, everybody, they all say that.
They've all got mentors, and everyone should have a mentor in this business with another dealer, another operator, somebody that they can talk to, and they do, and they share, and it's amazing.
Yeah, but the legends that I've talked to so far, and they'll be coming out on the podcast later, but Kathy Windsor, Lynn Leach, Gary Fair, they all say the same thing. They've reached out to somebody at some point in time in the industry who's technically really they're your competition. I don't care where they are, they're your competition. But because we're local and we're in local towns, you don't deliver that. I don't deliver into the next state. They have these conversations of, this is what you should try with your business. This is what I've come across. This is what you can learn. This is what you can understand. Call RGCO because they know what the heck they're talking about. There's something, and the camaraderie is unbelievable because I've seen the pioneers. I've seen the people who have started these businesses all the way from Daryl to Norm to all the guys that they've talked about, Larry Sutton. They all have this kinship that they have talked and gone over again and again and again the ideas of this business, and I agree with you 100%.
Speaking of Larry Sutton, I got to share this. Before we ever had any level of professional relationship, so imagine someone not even having a relationship. I went up to Larry and asked him if he would just mind having lunch with me occasionally so I could pick his brain, and he always did. Never batted an eye. Said, yeah, let's do.
Larry's great for a conversation.
And he talked to me about the RTO industry, his background, a little bit about what he's doing, and just shared with me things that you wouldn't think anyone would ever do, without having a relationship at all. Just some guy that he barely knew, just asked him to pick his brain, and he was more than willing to sit down with me and have lunch.
He's such a unique guy. Have you ever met Larry Sutton? Listen, they don't call him the Reverend for nothing. So if you ever ask him to lunch, you better be prepared for a sermon. But I mean, he is amazing. He's amazing. So, Alicia, and it's gonna be. I might have to be for both on this one. But biggest change you've seen in the RTO financial management?
That might need to be your question, just because I haven't seen enough yet.
I would say online selling and just virtual RTO.
Yeah. Oh, yeah, absolutely, absolutely
would be my answer.
There's two letters that come into play, and it's AI for everything. I'm hearing AI for everything.
It's the new thing. It's what's coming now. That's what everyone's talking about. Yeah. Including your podcast.
Absolutely. We talk about it a lot. So then we'll direct this one towards you. One financial habit that every RTO owner should develop.
I think Mike hit on it before, checking your balance sheet, making sure everything ties out.
Every day, every 2 days, every week? What would, and I know you're an accountant, so I've been trying not to get too far in the weeds in that, but if it was you, how often do you do it?
I would do it every day, but I'm very... Should I use the word that I use for everything?
You're just very detailed on that, right? There you go. Mike, best investment an RTO owner can make in their RTO business?
Their time. They've already put all their money in. It's important that they give their time to the business to do exactly what she's talking about. Spend time every day in your numbers. Pay attention to them. Reconcile cash daily. So to give their time to their business so that they learn their business. Remember, many of these people have transitioned to be owners that were used to be employees. Being a good employee does not make you a good owner.
Yeah.
It does not.
Yeah, that's
so you've got to learn to be an owner.
I think you also need to keep in touch with your employees too.
Yes.
And
but being an owner does not mean now I don't have to go to work every day. It means more. I've got to work more. I've got to pay attention to this stuff day and night and weekends and look at it. And it's just part of being an owner. So yeah, their time.
All right, biggest takeaway. This is both of you guys. Biggest takeaway from the 2025 Tax Act for RTO owners?
Bonus.
Bonus.
The bonus.
Bonus depreciation.
Bonus. And that wasn't one of my key words, but it is today. Their bonus depreciation is going to make it happen. So what's next for you guys? What's next for you guys in the RTO industry? What comes up next? What do you guys foresee in the next few years that you're going to be a part of?
I just rolled off being part of the board. So I was, as part of the vendor advisory committee, I was lucky enough for the last 5 or 6 years to be part of the board as one of their board liaisons. I've just now been voted off the island, so to speak, so I'm no longer on the APRO board. But that won't change anything. We'll continue to be involved. We go to these things because we become just as educated as we're educating while
Absolutely.
we're there. And there's only a few of us CPAs that show up to these things, and we know who they are. And we're all
Dan,
very
we're talking about you.
Dan,
Dan, we're talking about you.
I'll see you at the next one.
You can post on Facebook every day, you can go live, drop great deals, and it matters. But here's the problem. Only a tiny slice of people ever see it. That's the trap of organic. The people you need to reach, well, they're still scrolling right past you. That's where Gerard Marketing comes in. They turn strangers into customers by using Facebook ads that put you in front of everyone, not just a handful who already follow you. The dealers we work with are seeing more leads, more deliveries, and more cash in the door. So if you want momentum, stop waiting on organic posts alone to do the job. Go to fastrtodeliveries.com and let's get your ads working for you. That's fastrtodeliveries.com.
But he does a great job showing up, and he's very well respected. And we show up to learn, and not just to see the clients that we have, but also to learn about what's going on in the industry. And I think that means a lot. It means a lot to the industry that we do that, and we'll continue to do that.
Well, now that he's seen the off ramp, is there any chance that we're ever going to see Alicia part of the board?
Maybe.
Maybe. Oh, so we're not against it. All right, that's
We'll
what we
see.
talk about.
Or Janelle, you never know.
Possibly.
We're also trying to get more
she
people
today?
in
Where
the
she
office.
did not show up for the tax
yeah.
cuts. That's people, It's
She's
just
not in the office. She's remote.
She's remote, yeah.
But she's amazing for anybody that works with her.
that's good. So, coming out of what you do, because this is a big part of it. I can't emphasize enough how much this plays a role in a successful rent-to-own industry, a successful business. What does RGCO's legacy look like in the next 10, 20 years? Is it Mike finally being able to step back a little bit and have some of the younger talent here take over and be a part of APRO and be a part of the FRDAs or the RDAs period? Is it, we keep it streamlined and we just do what we do and make sure that we hunker down and give everybody the best tax advice that we can, the best valuations and EBITDAs that we can? I mean, what does it look like in the next 5, 10, 20 years?
We just came out as a firm of our strategic planning where we talked about the next 5 years. And we'll have some of our partners that roll out of here in the next 5 years that are ready to retire themselves. I'm not. My youngest is still in 6th grade, so I'm not going anywhere. But as far as the rent-to-own industry goes and our commitment and loyalty to it, it's not going to change. We're going to continue to grow, stay involved. Our committee shows that. The fact that Alicia is here shows that. I want people to know us in the industry, not just with my name attached to it, but others. And you only do that by showing up and becoming educated. So we're not going anywhere, and we plan to continue to stay involved. As a firm, we are also going through the challenges of learning how to use AI and what to do with that, and what that means as far as what our ideal clients are, training our people properly, and basically going out and dealing with technology and what kind of innovation we have to use so that we can train to serve our ideal clients. And rent-to-own is squarely within our ideal client. So, that's what's on next for us. The challenge, not just within this industry, but as a firm and all of the clients that we serve, is how to better serve them and continue to stay on top. Our firm size is very niche. We're not a big firm, and we're not a sole proprietorship either, as you've mentioned with our office space. We're about 85 people top to bottom. So we can serve small clients, we can serve large clients, we compete with the big firms on a regular basis. We don't serve publicly traded clients, and so the closely held, privately held company is well within our wheelhouse, and that's what we're going to continue to build on.
Well, he says that so nice. I know that in the beginning, the only thing that I was really thinking is his daughter's going to say, "Hey, Dad, what do you do for my college tuition?" So I got to stay here. I got to stay here and work this out.
I'm sure he's got that well taken care of.
I met your wife.
She doesn't play. She plays basketball, but she can't score in a gym by herself. So she's more of a defensive weapon.
Well, listen, there's a lot of scholarships out there. We're not going to put her down. She's great. Your wife's amazing as well. I seen her last time that we went to Washington for LegCon. Guys, just to let you know, if you can ever do LegCon, it's a great thing to do. Are you going to go to LegCon eventually? Are we going to see Alicia's face in the halls of the White House?
It's
or at
possible.
least in the Senate.
They've
and
got
the
to
House.
improve
He's
the
hyped
dates.
it up.
So I think this year it's literally starting on April 15th, which is the tax deadline. So we have supported it, and we'll continue to support it. Whether the dates will drive whether we can attend it or not, but I try to. Even this year, it was like April 8th through 10th, and I was there. So it's important to this industry. It's important to us. It's important to see. And so if you haven't attended, whether you're a vendor, dealer, or a manager, or just an employee in the business wanting to learn more, it's a time where we all show up and fight for this industry and talk about it. And it's great not having troublesome issues to discuss.
Oh, God, yes.
But they still love hearing the stories, and it's important that we continue to do that.
I think the podcast this year is going to try to be a part of the fellow program and see if I can get one person up there with me. I know that it changed my thought process of seeing everything. Not only the process of just being involved and saying, I've actually advocated for my industry. I can say that out loud. A lot of people, how long have you been in the industry? Have you ever done anything for it? No, I clock in, I go home, I spend the money that they give me. No, but to say that there was a clear advocacy for the advancement of the industry, or to stay where it is and make sure that it isn't changed in any way or form, like, the things that are going on in New York right now that have a lot of implication on what can happen in the future. So it's great to see that, and I'm definitely thinking about bringing somebody with me, because that opened my eyes completely as to what we were about and what the camaraderie is on a whole different level. It's one thing to see it at Meeting of the Minds. It's one thing to see it at RTO World. It's another thing to see it that everybody gets together under this same one banner to walk the halls of DC and say, hey, as a one voice, we're here as an industry. We're doing great for our communities, for the people, for our not only for just the communities that we serve, the employees that we have. There's a lot of employees in there. There's a lot of things that happen. The vendors that we support, the areas that we support, like you said, the schools that we support. It's so important. On our way out, as we talk about this, and we kind of settle on everything. We have talked about the big guys. We've talked about some of the small guys. What would you say as some advice to a new company, a new owner coming up that doesn't have a CPA at this point in time? What is something that you would say, if I'm doing this and I don't know what I already know, because Mike's got years and years and years of service and he's got an Alicia, but how do you say, this is what you should be looking for in your CPA? If you're looking for somebody, or this is the benefits of having a CPA at this point in time of your business, and I wouldn't go without it, these are my words of wisdom.
Spend the money on a good POS system that you can trust, and an accounting system. The taxes will come later. Generally, these businesses don't make taxable income in year one, so tax planning and things like that aren't something that you focus on out of the gate. It's cash flow. Talk to them about how to manage cash flow, how to pay attention to things we've discussed today, and understand that transaction. Control their spending, but spend enough to build your cash flow, your recurring revenue.
Right,
That's
right.
what you want. Your par, your SMR, your potential, whatever you want to call it.
Your ideal.
You got to your ideal.
Yeah.
You got to grow that, right? But you got to grow it in a way that you can afford. And so I talk to them about that. All these new dealers that are coming in this business that I get the opportunity to talk to, that's what we discuss, is understanding that. And taxes come later when you start making the money. But first, it's controlling the spend and understanding your cash flow management.
Do you have any, tax softwares that you would recommend?
We have our internal stuff that we have. The accounting software that's out there, QuickBooks Online.
I'm sorry, that's what I meant to say, the accounting software.
I
You're
figured
right.
that's
Yeah.
what you were talking
Yeah.
about. QuickBooks Online is perfectly good. It's easy to use. It links, it pulls in bank statements and transactions. It memorizes transactions. There's some other things out there too that work, Some of the POS systems are trying to figure out ways and have to talk to some of these accounting systems too, which is also good. It costs a little bit more to have that privilege and ability to do that. So QuickBooks, 90% of our clients are probably using QuickBooks, and so it's perfectly acceptable.
Well, at least it doesn't cost $1 million, right? You just need to know where your dollars are going and coming from.
That's right.
That's the important part. So if somebody says, man, that was an amazing show, and for some reason, I'm not using RGCO, what's some information? How can they reach out to you guys and say, hey, listen, this is what we want to do. We want to start using you guys for our valuations and our EBITDAs and everything else that falls in between.
And audits.
And audits,
They
right?
hit on audits.
How do they reach out to you guys?
Yeah, I mean, to her point, I mean, we do auditing services and things as well, because banks require it once you're at a certain lending level. You've got to do the compilations or the reviewed financials or the audited financials. So, yeah, we have a whole auditing department that does that when banks require it. But that being said, our website, www.rgcocpa.com, is a great way to learn more about us. My phone number is 813-202-1612.
As he remembers.
Yeah,
It's his direct line.
Yeah, that's my direct line. Is a good way to reach me, and our email. Our email is on the website as well. Both of us are listed there. So that's the best way to find us.
So go online, check you guys out. You can call Mike directly, or you can go online and find an email, send you guys out, and you guys reach out and kind of connect there.
Absolutely.
Well, I tell you, I really appreciate...
In case he got his number wrong, by the way, there is the main office line that you can call as well.
Yeah, 813-875-7774.
Mike Helton, Alicia Holloway, thanks guys for being here today. I appreciate you allowing me being here today. The site is amazing from this office here. I just want you guys to know this is the Ebor room. Is that what I said?
It is the Ebor room.
The Ebor conference room, and there's a reason for that.
Picture.
We are looking out at Tampa Bay, and it is absolutely beautiful today. Thank you so much for guys being here. I tell you guys again, please hit me up, Pete at the RTO Show podcast.com. You can email me there. You can also go on the website. It's www.thertoshowpodcast.com. You can feel free to go buy some swag on there, find out how to be somebody who can help out the podcast and be a sponsor, just like RGCO has. It's been amazing to be here. I want to tell you guys always, hit us up on Facebook if you want to do the DMs, Instagram, LinkedIn, and where you're going to see this on YouTube. Make sure you subscribe. And I would tell you guys, as always, thank you so much for being here.
Thank you for having us.
I am
was
so
awesome.
glad that I got a
Appreciate
chance to work this out. I've been trying to get Mike for a long time. But I tell you guys, as always, make sure to get lesson below to get your sales high. Have a great one.